It's going out there. It's January 27th. I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down the headlines and tell you what's really moving these markets. It's Thursday, interview day, and I got a great one set up for you. One of your favorites. And that's John Petrides, asset manager at Tocqueville. Guy you've likely seen on CNBC. Man, I think I see him on there every day now. In the media a lot. Great track record, which he's sharing lots of his picks in Dollar Stock Club portfolio since we have him on probably once a quarter. And again, the guy with a great track record. It's awesome. I know you guys see that. He's also a very good friend. Really good guy. And he's somewhere where I can go anywhere with the markets, which I love. Sometimes it's, I'll interview and the people that are sector specific or, just talk about, crypto or maybe the Fed. We go anywhere. He's one of those Andrew Horowitz types of guys. There's certain guys that I have on here that are regulars we can go anywhere and talk about. So we're going to really dig in because there's a crazy market. We're going to cover, what's going on, the volatility, the Fed meeting, where to allocate your money during this extremely volatile time. And of course, John is going to share his favorite ideas like he always does. So let's get to the interview right now. John Petrides, thanks so much for coming back on Wall Street Unplugged.
Hey, Frank. Thanks for having me on.
Pretty crazy markets, I'd say. And let's start there because you're a guy that we've done this for a long time, very, very good friend, and we can go anywhere pretty much, whether it's economics, the Fed, stocks, sectors, and everything. But let's start with the overall macro because this sell-off seems a little crazy to me, consider what down. And listen, we saw the Fed doing about face in November, but the risks pretty much are on the table where maybe, okay, we'll expect an extra rate hike. We know inflation's high. We get it. The Fed's outlined what it's going to do. To see us sell off the way we're selling off almost every day and seeing it broadly, you see like the deleveraging taking place, right? So what are your thoughts on this? Are we coming close to a bottom here, which I know it's difficult to figure out? And, what are some of the things that you're doing at Tocqueville and you're telling your clients right now?
Yeah, so I thought about this sell-off a lot, and I think that it's happening in multiple layers. So the first layer was right out of the gate. You saw a pop in interest rates, and the U.S. 10-year went from like 1.5% to 1.8% in a three-week period. And as we know, Frank, when interest rates go up, growth stocks in particular, and all stocks go down. But growth stocks, long-duration stocks, companies that they're, where the earnings and the sales won't come to fruition until 5, 6, 7, in some cases 10 years out, those get clipped the most. So that was the first couple of weeks of the new year, was the market recalibrating from a valuation standpoint on rising interest rates. I think the second wave of that pronounced the sell-off was, JP Morgan had a good earnings call, but it wasn't a great earnings call compared to expectations. You had a sell-off in some of the subscription-based companies, consumer subscription-based companies, where estimates were baking in a lot of subscriber growth, and it didn't meet that fruition. So that was, I think, a disappointment to investors. Then you have geopolitical risk back in the forefray with what's going on in Russia and in Ukraine, and Biden telling, diplomats to leave is not a good sign of potential things to come in that area. And then, Frank, I think there are structural issues going on in the market as well. You've had 3 years of massive returns, particularly in the S&P 500. On average, over the past 3 years, the market has returned 25%. And no one wants to sell in December because then you have to pay the tax bill. So I think you have some tax selling in January where you're reducing your position that you would have done in December. I also think that there are probably institutions, maybe sovereign wealth funds, that are probably rebalancing their portfolio where, again, if the Fed is taking the punch bowl away and U.S. stocks have done really well, their valuations are not as attractive as, let's say, Japan or Europe or even emerging markets, maybe you have rebalancing going on away from U.S. stocks, large cap, and into international. And, another structural thing is probably margin calls. I mean, margin rates where people are borrowing from their investment portfolio to either invest in other stocks or they're using it to, they're using their portfolio as collateral. When you get below a certain level, the bank comes knocking and says, hey, you have to replenish your portfolio because the value of it is down a lot. So I bet you this, because you're seeing some really high quality companies that are selling off really for no explained reason. So I think there are margin calls going on. And then finally, we're lapping the 1 year of the meme stocks and GameStop. And I think you've had a lot of retail investors that don't have a coach, don't have a financial advisor, aren't subscribed to your newsletter, is not listening to what you're doing from an investment, from an advice standpoint. And they're out there on their own. And I think they're really getting their first taste of a massive sell-off. Because listen, last year, the S&P 500 only had a 5% sell-off from peak to trough. So that is very low. Usually, for the past 40 years, the average correction from peak to trough during a calendar year is about 10%. And last year was only 5%. So you have many new investors in the market that have never experienced this type of volatility, and they may be panicking. So I think you have all of those factors together, and it leads us to where we are right now.
So when we see times like this, right, I mean, would you suggest being a buying opportunity? Because like you said, you can tell it has to do leverage, margin calls, because you're even seeing good names. Even gold stocks, I think, would be doing pretty well in this environment. I'm thinking financials, too. I mean, Wells Fargo just raised their dividend. JP Morgan results are pretty good, a little bit light on revenue, but still, higher interest rates are going to result in them expanding that net interest margin, right? It's usually good for them. And even those have sold off. So what do you tell clients that have come in where they've been so used to, especially over the past few years, and just to say that 20% average annual returns in the S&P 500 over the last 3 years is insane, right? When you really think about it, right? I think people get those expectations are high. But we were under conditions where numbers didn't matter because we had the Fed punch bowl where everything was at record highs a year ago. Household wealth earnings hit record high a year ago, and we still injected another $9 trillion into this market. When I think that's how far behind the curve is. And that's $9 trillion on top of $10.5 trillion, right? So now I think we're in the market where numbers matter. And I respected what you said last time I had you on. And this might have been before November, before the Fed, because you would talk about dividend stocks and companies generating cash flow. And, when you hear that, it sounds boring. But yet these are the stocks. Some of these things also got hit, which, don't deserve to get hit, because in a tough environment like this is kind of the names that are going to excel, right, and take market share. So, are you still looking at dividend stocks? Are you still looking, what are you telling your clients how to play it? Are you looking at, we've always looked at numbers, but now it's more relevant than it's ever been because numbers are going to matter, especially when you're taking leverage out of the market. When you have an unlimited amount of money, it doesn't matter. Everything's getting funded. Now it's a different landscape. So, how are you playing this in terms of financials, dividends, and things like that? And you could go into thematic investing, which, you're very big on.
Yeah. So let's take a step back. I think, when you're investing in the market, I think the first thing you need to do is understand who you are as an investor. And with our clients, we try to set their asset allocation at day one, understanding that, what are they trying to achieve? What's their risk tolerance? Because we know days or times like this are going to happen over the course of someone's life. If not one time, it's going to happen 10 times. So, you want to set expectations and manage risk and asset allocation appropriately to meet that person. So now is not the time to rearrange the deck chairs. That should have been done already. I think another thing that you pointed out during your question is this is not about fundamentals. This is about valuation. Underlying fundamentals by and large are pretty good. The consumer by and large is pretty good. Housing is strong. Although the Fed is, or rates are going up, liquidity is still ample. Company balance sheets are good. Growth stories are good. Things are getting gunked up because of supply chain issues, and inflation is playing with profit margins. But by and large, things are okay. So this is all about recalibrating valuations to a new normal of higher interest rates and realizing that valuation does matter at some point in time. A story isn't going to hold up if a company is not profitable. In the moment that those expectations go a little bit less, or the fundamentals or the results come a little bit less than expectations, is when problems happen on stock valuations and everything comes in. And as Warren Buffett likes to say, when a tide goes out, you see who's swimming naked. And that's kind of the environment that you're seeing right now. This is not about fundamentals. This is about valuations recalibrating. I think that's important. We still very much favor dividend-paying stocks. We do a lot of homework on those companies that can grow, sustain, and maintain their dividend during periods where underlying turbulences, underlying fundamentals weaken. Companies in one of our strategies, our enhanced income strategies, are very, very strong. We're yielding over 4%, and that's growing that dividend over time. Frank, I don't know if you want to go into some thoughts and ideas now, but I do think that the sell-off we talked about thematic. I think the sell-off in thematic investing has really got kicked to the curb. In 2020, you couldn't open up any financial news without seeing Cathie Wood from ARK Investment on somewhere. She was everywhere. And in 2021, it was the exact opposite. In fact, someone created an ETF to short whatever she's buying. That's unbelievable. So, and then all of a sudden, now there's this play against thematic investing. I think if you're able to put your long-term hat on, I think thematic investing right now is really attractive off of the sell-off. I really like cybersecurity as a theme. I think artificial intelligence and robotics as a theme is attractive. A lot is being, I think the world is moving towards ESG as that's not a new statement. And I think, companies and countries are moving towards more clean tech environmental solutions. So I think clean technology can exist even without Build Back Better, because that has been a headline risk. But I don't think companies really care about Build Back Better to a degree unless you're going to be that company receiving a contract from the government. I think the movement towards clean tech is going to continue to happen. So I think those are three themes, at least, that I think have a very long runway in front of them. And instead of, from a diversification standpoint, instead of anyone, if you don't want to go out, stick your neck out to pick individual stocks, buying a basket through an ETF is, I think, good risk management and diversification.
No, it makes a lot of sense. So guys, just thematic investing is, looking at long-term trends, right? Just in case you didn't know. And themes, which Cathie Wood has done, and she's done fantastic up to a point. And then, now you're seeing, her fund really, I think it's down like 50% from its highs, but it was up tremendously, like 200% outperforming the markets. Now, I guess the question to you is, there's so many trends like this. I mean, you can go into metaverse, AI, you mentioned, you can go almost anywhere, EVs, right? Autonomous vehicles. But if you're looking at the markets where this is where you've seen the most corrections, where semiconductors actually held up pretty well, better than the market, maybe down 10, 12%. But when you look at cloud companies, massive market, still, I wouldn't say it's not in its infancy, but probably in the second, third inning, right, of how big it is, growing still 35% annually. These names are down 33, 35% from their highs. So does that have anything to do with it where, yes, you see a nice discount and this is awesome, and you mentioned ESG names, Solo, those are down 30% plus. Is it just those three? Do you look at, hey, not only these themes are good, but I like ESG, and I like it even more that it's down 35% compared to maybe semis that it's down 10, 12% when you might not see the value. Do you look at it that way, or just like, hey, this is a great opportunity?
Yeah, well, I'll give you, in terms of our thematic, some of the themes that we're playing. So I mentioned robotics, AI. I mentioned clean tech. I mentioned cybersecurity. We have a play on clean water, water resources. We have a play on marijuana. We have a play on Ethereum and crypto. We have a play on biotech, human genome sequencing, that sort of thing. So, there's a whole bunch of themes. And right now you just have long duration assets. So, longer term assets are just getting repriced because of higher interest rates. But the underlying fundamentals in the research that we've done on those themes are really, really attractive, really attractive.
Yeah, and it is interesting when you say higher interest rates. No, go ahead. Sorry.
Yeah. Frank, another theme there, slightly different, and going back to your point on you were just going to make about higher interest rates, and going back to a point on income and dividend yields. Another theme, another way to play it is short duration high yield. So an ETF we like is SHYG. So this, like I said, this is not a credit issue in the world that we're in. Credit is really strong. So because in the high yield market, what makes things bad is when company fundamentals are bad and credit's bad. That's when buying high yield or junk bonds is dangerous. But you don't have that in today's situation.
No,
if the issue is rising interest rates, that impacts long dated bonds. So what we like, SHYG, it only buys high yield bonds that mature between basically today and 5 years from now. So your maturity is less than 5 years or less, and you're getting a 4.9% dividend yield. And it's an ETF, so you're getting a basket of high yield bonds. So we think that is actually, ironically, the high yield market may be a safe place to be in today's environment, because you're protected from interest rate movement, you're taking on credit risk, but you're getting more yield, and the volatility of that is going to be less than what you're getting in the S&P 500.
Yeah, and isn't it amazing when we talk about interest rates, right? We know the Fed say if it's priced in for 4 rate hikes, but if you look at the 10-year going from 1.4 to 1.8, which is a major move, right? 1.7,
Yep.
whatever it is. We're doing this before the Fed actually makes before the meeting, just to let you guys know. So they're supposed to say they're going to announce a rate hike, their first rate hike in March. Who knows what they're going to do? But just to let you guys know, I don't want to throw you under the bus if you make a prediction and then they're like, wait a minute, this guy knows he's talking about. But it says
I
the day
appreciate
before.
that.
But 1.8% that's where we went 9 months ago. And if you look from that point, even through 2013, I mean, that we were higher than 1.8 almost the entire time through, going into 2020. So, they're higher, but it's not crazy high where, I just feel like with this markets, and I could be wrong, right? I said there's a fundamental change that you need to adjust your portfolio. It's going to be more volatile than ever because the Fed, this is the first time in a very long time that they can't throw money at something to fix it. They got to do the reverse. They got to take money out of the system. I didn't see this much of a correction happening across the board. I have to be honest with you. I didn't see this much of a sell-off. And to understand the risk that we see, and maybe it's 5 rate hikes, I get it. But are we pricing in like a severe recession at these levels? Or maybe, hey, this is just because, again, we both know there's a lot of great opportunities out there. Good name stocks, not meme names, not garbage names, that have these crazy profiles and 15-year discounted cash flows, whatever, that aren't generating money and revenue. A lot of good names like Best Buy, 11 times forward earnings, 52-week low, down 30% off its highs, and growing earnings at 20%. Even if it's growing earnings at 10%, it's still cheap. I mean, just seeing a lot of these names, it seems like a buying opportunity, not just in dividend stocks, but maybe a couple of these thematic investing. I guess let's go there. Is there individual names that you could share that you're not giving too much away with people who pay for their research and everything?
Yeah, totally. So I don't think that we're headed into recession. I've come to, as I've spent most of my career on the equity side and stock side, and I've come to appreciate that the bond guys are the nose of the plane. And when the yield curve on the bond market moves, equity investors should listen more than they probably do. And the yield curve is steep, which means the market is expecting economic growth ahead of time in the future. So until I see the yield curve, or it's steeper, until I see the yield curve invert, then that means that the market is the market is starting to price in that the economy is going to lose steam and we could be heading for a recession. So I don't think that's the case. I think this is a recalibration of valuations going on in the growth sector, and growth in tech stocks have been, carrying the baton here for investors for 5 years now. And a lot of stories just went wild and it bid up stocks in probably too aggressive a way. And it happens. It happened in the late 90s in .com. It happened to solar stocks in 2007 to 2009. It happened to 3D printing stocks in 2013. It happened to marijuana stocks in 2007 to 18. It happened to crypto. Crypto's still down 50%, but all these story stocks sometimes get ahead of themselves from a valuation standpoint, and the underlying company or entity has to grow into that valuation. It took like 14 years before Amazon got back to its IPO price. Think of that. And where's Amazon today? So it takes time. Frank, going back to your one of your other points though, is I think one thing that investors need to appreciate is, when you're investing in something or you're looking at macro data, it's all about the rate of change. It's how fast or how slow something happens that impacts evaluation. What do I mean by that? Let's say, the price at the pump to fill up your car right now at national average is, $3.25, right? Let's say by next week it goes to $5. That would, and it stays at $5 for a while. That would slam the country maybe into recession because people just aren't ready for that. But if the price of gasoline goes from $3.25 to $5 over a 5-year period, and it happens gradually, well, people can budget for that, right? So your point on interest rates is the absolute level of interest rates, the 10-year, U.S. 10-year bond is at 1.75, 1.8%. Historically, that's nothing. That's really cheap borrowing of money, right? But it's how fast we got there that is spooking people, right? And that's the key. It's the rate of change that throws people off. And because remember, the Federal Reserve raised interest rates from 0 to about 2.25% from 2016 to 2019. So we went 225, but and the stock market did great. Now there are a million other factors what drove stocks during that time period, but by and large, if interest rates go in a slow and steady pattern, the whole world can sort of forecast better because there's no surprises in there. And that's kind of what's going on right now. The Fed is basically admitted they're behind the curve. They've printed too much money for too long, and things have kind of got away from them from an inflationary standpoint. And now they've reached one of their mandates, which is full employment. Now they're trying to sustain or stabilize price increases, which is the other part of their mandate.
Okay, so you have SHYD as one of your picks.
Yep.
What are you looking at? And again, you were talking dividend stocks and nobody, which, is the ultimate bullish sign, right? When nobody cares. It's kind of like, when you say something, people are like, you kind of know you're right. I hate when I recommend something. Right. Everyone's like, that's a great idea. I'm like, oh shit. Right. What are some of the names, even if it's, Thematic or if you're within.
Yeah. I still think from a yield standpoint, I think REITs, our real estate investment trusts, are still interesting here. REITs had their best performance in 2021, if not ever, definitely in the last 25 years. So you have seen some profit taking here to start the year, but I think REITs are very attractive here for a couple of reasons. REITs own a hard asset. Typically, they own an apartment building, a shopping mall, a data center, an industrial warehouse, college campus dorms. There's a whole bunch of things. They own a hard asset, goes up in an inflationary environment. It's just worth more. Secondly, they charge rents, right? And they can increase those rents at or above the rate of inflation. So that gives them tremendous pricing power to their underlying tenant, which helps them, get more earnings. And REITs are required to pay out 90% of their net income in the form of a dividend. So you're getting, I think, some inflation protection plus some yield. And by and large, the sector looks to be off. I'm, judging by my screening, anywhere between 10 and 15%, 10 and 12% to start the year. So I think there's value in REITs, no question about that. SHYG is another way to play some income and offer a little bit of protection on the downside. HACK, HACK, would be a cybersecurity play from a thematic standpoint. I think cybersecurity is tremendous. I think if you see a ramp up in geopolitical conflict, who knows what's going to come out of the Russia-Ukraine situation. But, I would assume most defense dollars are going to be done to protect against cyber war more than on the ground, right? I think that's where all of the money is going to be headed towards. And by the way, post-COVID, all of our lives have become incrementally more digital. I don't care if you were off the grid beforehand and now you have a Disney Plus account or whatever it is, you're now online, you're on the grid. And because of that, someone else has your information. So there's going to be a continued push to protect that. Robotics and artificial intelligence, bots, BOTZ is another ETF that we own for some clients on the thematic side. And, that's a play on the labor issue in the United States. We're either all feeling it. If you're a business owner, you can't find labor, right? Either people don't want to, there's a million reasons why. People don't want to work. People are ill because of COVID. They have family situations. Whatever the reason is, you're short-staffed. And that's only going to, and to get people to hire, what do you have to do? You have to pay them more. Wages are going up. You have to give out signing bonuses. You have to do all these things to entice people to come back to work. So if the labor situation can't get rectified soon, companies aren't going to sit and wait. They're going to invest in technologies to automate industries. That's just going to be the move forward. So they don't have to pay people. They don't have to worry about if people get sick and they don't have someone to cover their routes. We live in a just-in-time economy. And I think robotics and automation is going to be a continued theme, if not an accelerated theme, because of what has happened out of COVID.
No, it definitely makes sense. I always appreciate the ideas. So if someone wants to learn more about you, how could they do that?
Yeah, sure. So you can find us at, thanks for putting that up, we're Tocqueville. We manage about $10 billion in assets under management between individuals, families, mutual funds, and institutions. My team manages about 1.2, 1.3 billion of that 10 billion. And we build separate accounts. We manage for tax efficiency. We build portfolios for what clients are trying to achieve. And we use a mixture of, large cap core equity. We use a sprinkle of thematics. As I mentioned, we have our enhanced income strategy where we're getting more yield in the bond market with less volatility in the stock market. And we do taxable and tax exempt fixed income, where we're trying to round out a balanced portfolio for our clients to be an all-weather portfolio. Not everything is going to go up all at the same time all at once, but you don't want that because the purpose of diversification is to zig when something zags, and nothing goes up all together at the same time all the time. So that's how we do it.
Well, I have to say this picture, I mean, I have so many people that come on and they're always like, hey, here's my picture. And this actually looks like you. Usually people are sending me pictures when they're like 22 years old and they're like 50 now.
Yeah.
This is a really good picture of you. This actually, look at that. Look at that. And look at this.
Thanks, man.
And plus you're on TV all the time, CNBC. Mm-hmm.
Listen, that picture was taken about 2.5 years ago and pre-COVID. So I have significantly more gray and white, than I did at that time. So,
yeah.
So, don't be fooled too much by the overhead lamp that I have in my office here.
Usually I make fun of everybody. I'm like, come on, that's not you right now. What are you kidding me? And it's funny.
Yeah.
That's a good picture of you. But last thing, very important. We know we're in serious times, the stock market all over the place, but we always joke around because we really work hard. And not just joking, but serious. But we both take fantasy football seriously. How did you finish the year? Any championships? I know you were in a few leagues.
My son won one of his leagues. We usually do, and he made the semis in a father-son league. He was the head coach. I made the playoffs in one. Made some bad, poor decisions from a roster standpoint. I rode Myles Gaskin on the Dolphins, and that guy destroyed I picked him early. I thought he was going to be my guy, and he hurt my league. I'm in though, Frank, a playoff survivor knockout pool. And week 1 of the playoffs, I got every pick right. Week 2, you have to basically pick the winner, and then you have to pick the combined score of the game. And the spread that you come from the combined score, it gives you bonus points. So last week I got 1 out of the 3 right. I only got the Rams correct. But I had the exact point of the game. I picked 57 combined points. So that's kept me in the hunt for this upcoming week. I think I'm leaning Kansas City I think I'm going with the favorites in both of them, to be honest with you.
I think since he's a sleeper, because depending on Matthews, if he's back, man, Buffalo tore them up in the backfield. They got nobody back there. They got both their guys hurt. And I think, Burrow is going to eat them alive, and they beat them, but just under the radar, and the odds are pretty good. It will be interesting, but Kansas City definitely the favorite. And good luck.
Tyreek Hill is not human.
Did you see how fast he is on a toutouchdown? Holy cow. I mean he was running like the guy was standing still, like he should have got a taunting penalty, but he was like waving at the guy.
He reminded me of like Bo Jackson and Tecmo Bowl when we used to play Nintendo back in the day. He untouchable, unstoppable. That's what Tyreek Hill reminded me of.
Yeah, I'm hoping the games live up to expectations because, man, last week was probably the best I've seen in terms of every single game being decided by field goal or whatever. But really good stuff. I know we always talk fantasy football, which is good. Listen, open.
But how about yourself? Frank? How did you do?
I was in 2 leagues. One of them I didn't make the playoffs. The other league we lost in the semis. We were pretty much 5 games out. We won like 5 or 6 in a row. Had a good team and just lost in the semis. We should have won that game, but it was tight. We just got unlucky. I think we had Brady, and Brady did nothing in the second half of one of those games, and he just crushed us. Yeah. Crushed us. I was like, so pretty good team, but it was a tough year, right? A lot of people were hurt, right? A lot of great picks, so did okay. Second place, not too bad, but again, I have a great partner that helps me out, just like you have your son helping you out. You're busy doing a lot of stuff, but John, I thank you so much for coming on, man. I mean, you're a really good friend. You've been doing this for a while. You always provide ideas. People love you. Open invite, as you know, but I really appreciate it, man. I know how busy you are, especially.
Thanks for having me on. I appreciate it. Yeah, I appreciate it.
All right, I'll talk to you soon, right, buddy?
Thanks a lot. Appreciate it. See ya.
All right, great stuff from John. He's a really great analyst, even a better guy. Just to show you what type of guy he is. So in January, February, I was just doing a lot of research on the markets. And this is in January 2020 for the market crash in like late February. And I noticed that China was closing. A lot of people weren't talking about it. Everybody was bullish on CNBC. And I wanted to get on TV. And not that I wanted to show, believe it or not, I know it's going to sound cheesy, but I gave a shit. I just felt like the advice and what people were seeing, they were about to get wrecked. I've never called a crash before, but interviewing on this podcast, people are locked down in China, in Italy, and understanding and having the right resources, which I was fortunate through this podcast, really being able to see that and saying, wow, well, China's closing right now. Apple stores are closing, Levi's store, everything in China is closing. We're sitting at a 22 times, 23 times forward multiple in the S&P 500, a massive growth multiple. I understand easy market conditions, but you're taking away the biggest growth component, which accounts for 40% of the world's growth, which is China, which is closing, and seeing and understanding and talking to the right doctors and things that, hey, this is coming here. I wanted to get on TV. So I reached out to 5, 6 of my good sources, analysts that go on TV, and there's a little bit of an ego behind that where it's, it's my time. I want to be on TV, and you have to go through the producers and stuff. I've been on TV, numerous times throughout my career. I just don't like it. I'm not crazy about it anymore. It's just, to me, it's a waste of time. It's not going to result in more people, signing up to my newsletters or anything like that. And, the agenda always changes. It's just more stressful than everything. But yeah, I really felt like here's the time I had the message to really tell people. And it was different from what everybody was seeing. And I think it's 6, maybe 7, but like six of those people never got back to me. They're like, oh, I'll try. Never got back to me. John sent me a list of like 3 of his contacts and producers, and I reached out to them, and it didn't really work out, but, I was talking to them, and he actually took the time to send me, the producers' names and everything. And, I think it was one that was going to go on. Then it wound up going on Charles Payne, I think, who's a friend of mine. But yeah, he really goes out of his way, introduces me to a lot of people and say, hey, this might be a great guest on your podcast for your listeners and what's going on now. And, so he's someone that's a very good friend. Again, it's not why I have him on, because this is an investment podcast and I screen my guests thoroughly. I mean, I just interviewed a guy and it was kind of frustrating. And when I interview people, I know everything about them, everything they wrote. That's my job, right? I mean, that's why people like to come on to this podcast a lot, because after an interview, they're like, well, holy shit, man, that was awesome. You really knew everything. And I really like to tie it into even like on a personal effect. They have something on LinkedIn or Facebook account. Everybody has Facebook accounts now and social media accounts. But, I want to see what this guy is saying. I'm interested in what he's saying, and I want to learn more about him. And one person that we interviewed wanted to come over to the company and, kind of high profile. And, again, I was reviewing a lot of it, asked a lot of questions. So I knew a lot going into the interview. And he was asking me a lot of questions that he should have fucking known if he did a little research, especially if you're looking to come over to our company. Know like how many products we have, know what we're doing, go to our website at least, right? I mean, even if you go into interviews and stuff, know the company, know everything about your company in an interview. And know how many employees are there, know the person that's interviewing you, which is important. You might be there for 13 years, 15, whatever. But man, that gives you such an edge compared to everybody else, because when you're sitting in that chair, you kind of, you're the same as everybody else. I mean, for me, education doesn't matter. You give me someone that's going to work hard. I mean, you can't teach someone to work hard. Give me someone that's a diehard, that's going to go all in. I could teach you how to be a great analyst. I've done that before, even people here at Curzio Research. But, it's just surprising to see that people don't go out of their way to, do that kind of research. Is probably why 100% of the guests that I have on all want to come back on again. Every one of them, like, that was a great interview. It's awesome. And I'm like, look, I'm just really interested in you and your style of investing or what they're doing. And I'm fascinated because I love to learn, even if I have a difference of opinion. Like, people are upset that I didn't attack Mooch as much for politics. But, what does that do? I'm not going to change his mind, right? I mentioned I'm not going to change his mind on anything. Yes, I disagree with a lot of shit that he's saying, but the amount of money he has in crypto, the fact that he can invest in our company, the fact it's a great resource, the fact that I can get to the SALT conference where you have, ex-presidents talking, past presidents, and the biggest hedge fund managers and more crypto funds and stuff like that. You got to look at the bigger picture sometimes, right? And you could fight all you want, but for me, I love this part of the job. I love it. And John's just a great source. He's been a good friend. And what I love the most is he's got a great track record. He's telling you buy dividend paying stocks. Last time I had him on, which is before November, which I'm sure people are like, yeah, whatever. I'm going to buy Virgin Galactic at 25 after all the insiders sold out. And now it's 8 Virgin Galactic? It's amazing, right? When it came out at 10, you had Chamath and Branson saying, this is the greatest thing ever. You have to invest in it. It's awesome. It's 8. How come you're not getting back into it? Because you made a fortune off of the retail investor, which sucks, right? That's Wall Street and it sucks. But, Yeah, with Johnny, he's ahead of the curve, very good, and just a good friend. So again, this podcast is about you, not about me. Let me know what you thought. FrankCurzioResearch.com. That's Frank at CurzioResearch.com. And you can find all of John's favorite ideas. And I don't talk about Dollar Stock Club as often as I should. But what we do is we take a pick from almost every week, someone that I interview. Sometimes, I'm not going to interview somebody in a week, depending on if I'm traveling. But I would say about 45 out of the 52, sometimes 53 weeks, that I'll be able to have an interview. And what we do is we take a stock pick from them. And it's not necessarily a stock pick that they may say on air, because I talk to them before and after we discuss ideas. But I take one of those picks, we analyze it. Daniel does a lot of research on it as well. And we provide a one-page report, and it's called the Dollar Stock Club. And it's one of the greatest freaking newsletters, I think, because we charge $4 a month for it, which is insane. So what we do is we just want to show you, for new people who've never subscribed to our services, right? We have something to prove to you. And you see something like this, now you're getting picks from the pros for $4 a month. Give me a break. And you're getting lots of picks, and we provide stop losses to buy up to, and we provide a nice one-page report. I mean, these are, us analyzing these stocks that they mentioned, right? So it's not like, hey, Frank, use that stock. We're looking at 3 or 4 of them, and I'll look at Daniel, look at it, and I'll, basically base it on where the stock is, the earnings and stuff, and say, hey, this is a really good idea. Let's throw this in Dollar Stock Club. And it provides lots and lots of ideas. But for $4 a month, that's where you find John's ideas. And you could see, his ideas are good. And we get to track these people as well for their ideas, which is important. Because if they're, giving you picks that the last 3 times I had them on, those picks down 40%, I'm not going to have them on again, right? I mean, that's my responsibility, my job. I don't want to put shit in front of you, right? We all want to make money and be held accountable, which nobody's ever held accountable, especially on Wall Street lots of times. You could lose money and then wreck a fund and raise $1 billion like a week later, right? I mean, there's just no accountability these days, but I like that accountability to see who's good, who's not, and that helps me put people in front of you. But Dollar Stock Club, if you want more information, again, $4 a month, absolutely nothing. It's like a newsletter just to say, hey, this is what we do. When we have other great products and services, and some of them are from a low end to very high end in terms of price. Never since I've been doing this for 30 years, anyone said, I just paid for this newsletter, it wasn't worth it. You'll see it's worth it. We do videos, tons of videos, video issues. You're seeing, I'm educating you on these things, which is really cool. But, Good Start newsletter, looking for new ideas from the pros, from guys that do this, for a living. It's really cool. Dollar Stock Club, we started a couple of years ago, and we have tons of subscribers for it. But I don't pitch it enough. I don't talk about it enough, but it's really cool. If you're just looking for lots of stock picks, quick read, buy up to price. Again, we do a lot of research on these names. We're not just giving them out to you, but and some of those names you won't just find through the interviews. You'll find them if I'm talking offline, before the interview, after the interview. So you're not always going to be able to sneak that pick in there and say, I know Frank, he talked about this pick. This is the pick we're going to use. Sometimes you'll hear it, sometimes you won't. So, but it's really cool. If you're more interested in learning more, you can go to our website, CurzioResearch.com. Again, it's a really, really good price point. And look, we have a cancellation policy that's very, very easy. You just go to our website and you cancel. It's not like you got to jump through hoops like Disney Plus, right? You try to cancel Disney Plus, good luck. You're not going to cancel Disney Plus. You got to go through forget it. You got to call like 10 people and go through this whole, whatever. It'll take you hours. If you don't want it, cancel it. If you like it, continue it, and you get charged $4 a month. And, we make it simple. Look, we don't want to give you something that you don't want. So it's all automated. It's all there for you, and it's a pretty cool newsletter. But we do get some questions about it. And there it is, Dollar Stock Club. So, guys, that's it for me. Questions, comments, feel free to email at frankcurzioresearch.com. That's frank at curzioresearch.com. I really appreciate all the support. I know I say that every week, but I truly do. Looking forward to our token launch, which is just a couple weeks away, which is exciting, launching on T0, which means anyone listening to this is able to buy this. I mean, except Canadian investors, unfortunately, but that's going to open up pretty soon. But, it's over 40 countries the platform supports on T0, but it gives you a chance to buy an equity stake in our company. And, you don't really have that opportunity a lot with publishers, which is cool. And you're getting in pretty much at the ground floor while we're still a small company and we continue to grow. So exciting times coming, and none of that would exist without you. So I just really, really appreciate all the support and what we're doing here, what you guys believe in and stuff. And, I take that very, very seriously. So, again, questions, comments, I'm here for you. Email me anytime, frankcurzioresearch.com. And I'll see you guys next week. Take care.